hello, my friends from Jeep on Facebook group of investment. Here we have our guest, her Art Wieland, uh, who will talk with us about risk and money management. So before we started, let's tell a few words about our guest. Our guest is a certified financial technician, coach and trainer. As a professional trader, he has been dealing with the subject of investing and trading for many years. I have read his book, Risk and Money Management for Day and Swing Trading. And I arrive at this conclusion that investing and trading it is a hard thing to do. So so now let's give uh, the word to Art Wieland, who will explain his this term of risk and money management, and he will give us some examples. So Art.
Sure. Thank you so much, Mitya, and greetings to the Romanian Facebook group. And I'm very excited being here and talk a little bit about risk and money management and what it's about, what you of course also have to take care of. And if you hunt for profits and if you want to have good profits from trading and investing, you always have to consider that you need to take over a certain risk, right? And what most of people, most of investors really forget is that risk is one thing, and if you want to get some profit, that's another thing. Usually you enter the market just thinking about, hey, I want to make a profit of, let's say, 5, 6, 7, 8% or so. And what we always have to be aware of is that with the hunt for the profit, there's always a risk to be taken over. And Vijay, as you have read my book, I always say, okay, you have to consider risk, you have to consider profit, potential profit, and you have to ask yourself, is the trade worth the risk? So do I have to do this trade, or it's better to wait? Do you remember why this is possible or important?
I don't know for sure because you are the expert, but all the time we think all the time we think about the potential profit, and we forget that there is a risk
Sure.
of doing that trading or that operation on the market,
Yeah.
because we see the other participant which say, okay, let's buy, and everybody goes with the herd and nobody say stop. Well,
Yeah.
stop. You must consider to put a stop loss. You must consider where your plan of trading doesn't worth it. You you cannot make 10% in just a few seconds. There are a lot of risk. Also, you have the opponent of the market which say, okay, for me, i have I have just 20. Now let's go a little bit more. I have 25. When you are entering, your opponent is still uh, selling his
Yeah.
position. So you enter, but you soon realized that you aren't in a winning side. You are in a losing side.
Yeah.
So because of that, we must put ourselves targets from the beginnings, where to stop, where it's our potential profit, where it doesn't work to have this position anymore.
Mhm.
And in your book, it's all about probability. So nobody
Exactly.
talks about the probability. And like other specialists says, you have 50% of winning. It's like throwing a coin. You have head
Mhm.
and tail. So you have 50% times when it's head and 50% times when it's tail. So this is this is this is it is your chances 50%. This is
Yeah.
a not a psychological part, this is a realistic part of your trading.
Yeah, you're right. And I mean, that's basically the idea. So if you go to your usual normal life and you think about, hey, I have a friend and I have the speaker right here, and I lend my friend the speaker because my friend comes and says, hey, can I borrow the speaker? And he says, okay, of course you can have it. It's very nice if so what is the risk of this? That your friend goes away with the speaker and you never see the speaker or the friend again, right? So this is
Yes.
mainly this is the worst thing that can happen. So of course you're aware of this. So, but why do you give away the speaker anyway? Because you know this friend, and there's a very high probability that you get the speaker back. So you're at least zero, no profit, but no loss at all. So you
Yes.
give away your speaker. But what is pretty nice then is if, for example, your friend comes back, gives you the speaker, here you are, and gives you a nice pen also as a present and a thank you for, hey, thanks for lending me your speaker, it was very great, and this is a pen for you as a thank you and a gift for you because you gave me your speaker. So you made a profit of a simple pen as an example, right?
Mm.
So this is your profit. So you risked, like, let's say the speaker, you get back the speaker and you get also back a profit as the pen. So the question is, in real life, would you lend the speaker to a completely unknown person? Of course not.
Mm.
Why?
Mm.
Because the probability that you get the speaker back is pretty low because you don't
Yes.
know this person, and there is no need to give you the speaker back for this person because he don't know you either. So you wouldn't do it. And let's switch over to the stock markets or to trading, investing. People behave pretty different then because they open a position just because they think, hey, okay, I can get a profit because I'm just entered the market, I just opened a position. And the very moment they open the position, they take over immediately. It is a risk, and the risk is loss, the risk of losing money. So the question is, why should I enter a trade? Because I have a higher probability, because I made my analysis, and there's a good chance of getting a profit rather than having a chance of losing money. Otherwise, you wouldn't open a trade or a position. You won't take over any investment. You wouldn't do anything because you don't want to lose money firsthand. The same way that you don't give away your speaker to an unknown person because the risk of losing the speaker forever is too high. So you better give it away to a person you know. So you make an analysis and then you make a decision, then you enter the trade. So
So
you have an action.
So let's say that you must trust this person or this listed company before
Yes.
you start to give your money for his development.
Yeah,
But
not
but
exactly.
but until you give your money, you must
Yeah.
understand that that company needs this money for development in some years. So
Yeah.
your profit will not be very soon. It will be in the future. So if
Yeah.
the develop of the firm will go faster than you
Hmm.
think before, it
Hmm.
is probably a good reward. But we must understand that all the firm needs money to
Yeah.
develop and to, I don't know, obtain different contracts, have new orders on his normal activity. So we must think that we give our trust. So it is good to give your trust to your friend, but it is also good and good to trust the financial company situation when you see that they have a good cash flow, they have contracts, they have good revenues, they try to cut their expendings, cut their losses, they try to give you some clues about their development in time.
Yeah. Yes, you're right, Mitya. And the point is, it's not about only about having trust to the company you're investing in, because you will never know really if the company is a good one or a bad one. You don't see really what's going on in the books or in accounting or so. You don't really get an idea of how marketing or management really works and goes. So you have to make your own analysis. And I'm a technical analyst, so I'm a market technician. I'm reading charts and I'm making my analysis, and then I make a decision on if I want to enter a market or not. So when do I enter a market? I have a strategy. And the strategy, you know this, it's called the expander strategy. It's the idea of entering a market in a way or a situation when a certain move is likely to be overstretched and is about to reverse or to correct at least. So this is what I feel like, or what I like to see, the kind of analysis, and then going into the market or make a decision of going into the market. But I have always to be aware, when is the point reached where my idea I have from analysis isn't valid anymore. So when the probability of reaching really a profit, of making a move into my direction, that I really get a profit out of the trade, when the probability is at least zero, if not negative. Negative means it goes to the complete other side. So as an example, just imagine you have a situation where market rises, price rises, so you have really like a rally. And the market is very steep, it's high, it's going up and up and up, but somehow there will be a point of some kind of exhaustion. And as a technical analyst, you can read these signs. So, for example, there might be some kind of candlestick. You know what I'm looking for?
Yes.
I'm looking for a shooting star. That is, you have a full body candle, and then in a certain moment, it goes completely sold, and what's left is just an upper shadow. Maybe a big one, a long one, maybe not a long one, but you see there's already some selling happening. So this gives me my edge. This is the moment where I say, okay, this guy looks familiar to me. I will lend him my speaker because I know this guy already. There's not the risk of not getting my speaker back. It's lower than the risk that he hands me a pen after he gave me back my speaker. So the risk of losing money with my certain setup, and of course there are a lot of setups out there, so the risk of losing money with my certain setup is lower than the probability of making a profit. And that's the whole game. That's the whole idea. So you need to have a setup. But of course, what is risk and money management then about? It is about of exiting your trade at the moment where the idea you have is gone, because the market does the exact opposite thing what you have thought of. So when your analysis turns out to be wrong, which is not bad, things happen, but then you have to go out of the market.
So, Arlt, how we can manage this thing of taking quick profits and letting our losses go down and down and down? It is a, I don't know, a psychological thing to do, or make this, I don't know, you must be very equilibrate and say, okay, the definition is that I must let my profit runs. Okay, your profit runs until 20%, 30%, 40%, 50%. how
You
much.
never know. Yeah, you
And
never know.
also your losses must be cut somewhere. Where?
Yeah.
10%, 20%, 30%. Because in my case, I have sold this equity from I was 2015 was
Hmm.
somewhere within zero point 0.5 and goes down to 0.2. So this was 65%.
Hmm.
In that period, I didn't know about risk and money management, and I say, okay, probably this is the end of his descending move. So
Hmm.
let's wait. Also, another 3 years goes back to zero, almost zero point 0.5. So in this period, I took the dividends of this company. So
Hmm.
uh, we have these problems between, when you divide 10 at 5, you have 2. If you get 2 euros for
Hmm.
every year of this company, like a dividend, so in
Yeah.
5 years, you obtain the 10 euros which you have paid when you bought the action. But they say, no, you must cut your losses, try to find the right spot where you should enter 0.2, and from 0.2 go up to 0.5. So the rise is almost double
Hmm.
if you have this knowledge of risk and money management, because nobody talks about it. And now we find over years of experience that we didn't have the right I don't know what to say, the right uh, way of doing the things.
Hmm.
We also look forward to see, oh, this is profit potential, let's go, run rabbit. But comes the wolf and no profit, and also your losses go down. You have a
Yeah.
permanent loser, and you say, okay, the things will change, and you let your time goes, and you keep with your teeth that
Hmm.
he will rise again. So probably
Yeah.
your book says different of this thinking, because this thinking is all the small investors are, I don't know, aren't
Yeah.
trained in this way. But some, I don't know, they have this pattern of doing these things in investing.
Yeah. So two points, Mitya. First thing is, you already mentioned it. The problem with letting losses run and cutting off your profits is a psychological one, and it's driven by fear and greed. That's one thing, and the fear is of really losing money. As long as you just let your losses run, they're just book losses. So the moment you pull you exit the trade, so you push the button and say, okay, I'm out, I just take the losses now. This is the moment when things become real. And then the pain is really there. But the moment, until you don't do this, the losses are just in the books, on the screen, but not in your purse, in your wallet. And that is one thing. Second thing is about this, that the very moment you have losses, your brain thinks, and this is what you do then, okay, this is just a move and it will go to the preferred direction after the move, so no problem, I don't worry. I just read somewhere you have to really believe in what you're doing, which is right, but only up to a certain point. So it's not the moment, like you say, I'm losing 5, 10, 15, 20%. That's the wrong way to go over this risk. So what you need to know is always in the chart. And again, I'm a technical analyst, so I'm a believer on charting technique. The moment, or what you need to find out is in the chart, where is the point, where is the price, where is the pattern, where is the region my idea of a trade is dead. Where is it? So if you think about some kind of definition of a trend, like it's going up and we have an up move, then we have the correction, then we have the next up moves and the corrections as they go. And you know, if the price goes up and you say, okay, I want to buy, I'm a buyer, I buy a certain stock, then you have to find and define a point in the chart where you say, okay, my idea is over. And this is, for example, the moment where you say, okay, we have an up move, we have a correction of it, then we have a low, you know, we have a higher low, a higher high, higher low, higher high, higher low. So you place your stop loss underneath the last low. And the moment the price goes beyond this, you're out. Because the idea of rising prices is dead at that very moment because the trend is broken. So as an example, so according to the Dow theory and the definition of a trend, so if you have not the sequence, and this is the basic concept, of course, but if you don't have the sequence of higher highs and higher lows anymore, but something like we have a high, we have a low, we have some kind of whatever high, and we have a lower low, then you have to go out, because all the idea of having rising prices again and again and again is for the moment over. And as you and me, we don't know what the future is about. We have to take a step back and just see what's going on in the market. How will the market behave? What will be the next move? So we can't predict the future. All we can do is making some kind of analysis, seeing what are the probabilities. Are they positive or zero? And the moment they become zero, like breaking the previous low, you have to go out of your position as a buyer, as a long buyer, for example. And the same is true also for the opposite direction. If you're a seller and the previous high is broken, what do you want to do with a selling position? You're on the wrong side of the market, so you have to go out. But not with 10 or 15%, but in a matter of, okay, where is my entrance point? When did I buy? Where is the point where I have to go out, like the previous low? And the distance between entry and exit, this is the price where you can have your calculation of some kind of position size. So like, for example, it's 10 euro, dollar, or whatever currency you're trading. And you have, like, let's say you want to take over a risk of a total amount of, let's say, 1,000 euro or dollar or whatever, then you can buy 100, right? 100 multiplied with 10 is 1,000. So that's the risk. So you buy 100 stocks of, I don't know, ABC, for example.
Yes.
Then this is the concept, the basic idea of risk management, because you never know how the future will be. So you just can have a plan, and if the plan doesn't work, you have to go out.
So will be the receipt of how you should behave in the
Sure.
capital market.
Sure.
So also I have a question. You know that these professional traders have this make their analysis upon how the price of the stock has moved between 6 to 25 months. From this calculation, they find this average true range. So the stock has moved -2 +2 in this I don't know in this distance. So you cannot make $5 because this is +2 -2 is the range where. So you must also make this calculation before.
Right.
There is 1% probability that will go more than two euro dollars. So beware in the front of everything you do, that there is some calculation, there are some statistical of the equity. So it happens only one time. So we have also in Romania, when you start to calculate also the difference between the maximum price and the minimum price. So you have 0.1. In 99 cases was 0.1. We have 1% where it was 1. But if you the probability aren't in your favor. So be aware of that, because because of that, it is also good. Also, nobody talks about the position sizing. You must take 2 or 6% of your total capital and engage in one trading, not all your capital. I also do this mistake. I think, okay, it's very good. Let's I don't know, horse this equity, because it has potential. But comes the other, you say no potential, and you try to understand what has happening. Nothing has happening. The other guy has risk and money management. So say, okay, for me it's good 10%, so I'm out.
Yeah. So what you mentioned here, right now, Mitya, is that, like I say, the ATR, it's like the movement of plus minus $2, euro, whatever currency it is, and you expect, or you want to get as a profit for your trade, like, let's say what you said, $5 euro or any currency, let's say 5, whatever. And this is the moment where you have to be realistic. So the question is also, what can I really expect in a certain move? Of course, in the long run, quite everything is possible. But the question is also, are you a long-term or short-term investor? Are you, sorry, are you a trader or are you an investor? And the investor, of course, says, okay, I'm buying also not just the stock, but also the story behind the stock. And yes, I know, maybe I think this will be double, triple, quadruple, or even be a 10-bagger, but I have to be aware that things will go up and down. So things will move. I won't go there with one single move in one direction and that's it. So it's just about an impulsive move, a correction, impulsive move, a correction. All I have to do is just wait and manage my position. So we're in management mode again, and just see, okay, what is the moment where maybe the up move is completely over and the stock is going from an uptrend to a downtrend. And even as an investor, you don't want to be invested in a downtrend. It's okay to be in an investment if there's a correction, as long as you're still in the trend. But if you're invested as an investor in a downtrend, you have to get out, because you can always, that's the main point, you can always go back whenever you want to for a lower price and a better price. So you can buy even more for your money. And that's why also as an investor, you have to define for yourself some region where you go out of the position and save your money in order to invest even more when the storm is over. That's one thing that you mentioned. Second is that talking about position sizing, of course, and of course it's very, very important, because if you just jump in with all of your money and you do the wrong, so you buy the wrong stop or go in the wrong direction, you lose a much bigger portion of money that you really can afford to. And this will be something that not just destroys your account, it also destroys you in a psychological way. Not really forever, but for a moment. And this is also what you like to avoid, because investing and trading is not everything in life. It's about making money. But life is bigger, hopefully. So there's more to explore, more to discover in life. So if you bring yourself in a position where you lose all your money first, and or second, lose also some kind of confidence in what you are doing, then, well, it's overdone, it's too much. That's why risk management is also good over there and important as well.
Yes. So let me see if I can give you a question. I also make I don't know, a chart which will be put on our Facebook. What it is more important to have a good risk reward and money management, 1.3 and 2.6%. This is A. B. To understand that the biggest risk is that you think that you have a winning strategy when the market tells you with arguments that is a losing one. 3. To understand that we live in an ambiguous world where a lot of infos are released and we are not awesome to know and understand every information. And 4, which I am, I don't know, I like it very much, to have like a game level approach in your investment. Level 1, 1 to 5%. Level 2, 6 to 10%. Level 5, 21 to 25%. So in your opinion, which are the relevant answer at this
Well,
question? What is important? Because we have this thing that, okay, we are awesome, we have a winning strategy, but the time goes and we see that we aren't winning, we are losing. We must put money, and this risk management, you not get to start with risk money management because you have a losing strategy. We have this
right.
ambiguous world where we hear and listen a lot of information which aren't complete, all them. They say a few guys were hit by the police car. Nobody said that these people were on the street. Okay,
Yeah.
these people should not go outside until 12 o'clock in the midnight. So, okay, so which it is your answer or your argument upon which will be the best answer?
Okay, so let's see. So number one was 1.3 or 2.6. Which kind of profit risk ratio will be the better one? Well, let's talk. Well, this question is pretty easy to answer. 2.6 is even better than 1.3. The question is, can you really reach this in various in a lot of trades? And therefore, what you have to keep in mind with talking about risk reward ratios is, of course, that in order to reach 2.6, you also have to go over 1.3. So we're talking about probabilities again. And so the question is, which one is more likely to achieve? So it's pretty easy. So before reaching 2.6 or whatever will become or will be above it, in order to reach this, you have to go over here. So if you say, okay, I'm hunting for 1.3, 1.5, probability is much more higher to reach this than to go to 2, 2.5, 2.6, whatever it will be. And then the question is also, and as read of my book, my money management metrics, which is pretty easy to understand because we're talking about here in this money management metrics about the risk you take over, the number of trades you do, the risk reward ratio, and the probability of your hits, so the hit rate. And if you say like, hey, I risk like 1% of my account, like let's say you have 10,000, you risk 1%, it's 100, let's say euro. And so you risk 100 and you say, okay, I have maybe, let's say, a risk reward ratio of 1.5, right? You have a hit rate of 50%, as you mentioned before, like 50% of my trades will lose 1% of my account, 100 euro. And you make, let's say, in maybe a year, 100 trades. That's not really much, but well, it's some kind. And after you do all this combine this together, you do this calculation, you end up with a return in total, a total profit of 25%, which is pretty good, right? So the question is then, will it be better if I have a higher risk reward ratio? Of course, maybe it will be better, but the question is, how high is your hit rate then? Is it still 50% or is it lower? Because it's not that easy to go to 2.6 every second time, like 50%. Maybe you just reach 2.6, like just 40% of all of your trades, and you that 60% go into the total loss of 1% of your account. And this is where you can do the math and answer this question by yourself, because then maybe you're better off to take your profits a little bit earlier. Of course, risk reward ratio has to be positive, but not too high, because the probability of reaching a high, really high risk reward ratio is low. And I don't want to take over trades with a low probability of getting the reward, right?
Yeah.
So in my case, it's better 2.3 or 2.5, 1.3 or 1.5 than 2.6. Of course, everybody's dreaming of it. And if you show me a market with very nice swings where I can enter on a regular basis trades offering me that higher risk reward ratio, I'm in. But praxis says, okay, it's very likely that you get with like 50% or so, 1.5, something around that area of numbers. And then you have to make the decision, okay, will it be enough to have a lower risk reward ratio, but more trades as a profit? And isn't this the strategy that brings me to a better total profit, right? So that's one point. Please tell me your second question. What was it about?
To understand that the biggest risk is that you think that you have a winning strategy when the market tells you with arguments that is a losing one.
Yes. Well, that's a very interesting question, because I know this by myself. I'm pretty sure everybody knows this. People tend to think I am right. In trading, there's just one participant in the whole, let's call it game. It is not really a game, just to make sure that we understand it, but let's call it a game. There's just one factor who is always right, and that's not the trader, it's the market. Right? So this is what we always have to be aware of. There's not one single person being right all the time, except of the market, but the market is not the person. It's a sum of all participants. So the point is, the moment you are experiencing really bad outcomes of trading, you have to at least make a break. And that's for a good reason. That doesn't mean that you have a bad strategy or a losing strategy. It just may also mean that market condition right now doesn't fit to your strategy. For example, if you're following a trend and buying or selling breakouts from highs or lows, and the market is in a range, you will end up as a loser. But your strategy isn't bad. It doesn't fit to the market condition. So you have to wait until the market conditions change, and then you can use your strategy again. But you have to be aware of this, and you have to really realize it, and then say by yourself and to yourself, okay, your chair, stop. Go for a coffee. Maybe let's say maybe you're intraday trading, like let's stop for the morning, come back in the afternoon, and let's see what's going on then. Mm-hmm. And that's honestly speaking, that's one of the most misunderstood concepts. And this is one of the most dangerous things we can face as a trader, especially in a short time frame, like intraday trading, because we got stuck and sucked into the market and forget about ourselves.
Yes, we only see the movement up, down, and we do not know what to do. So so free to understand that we are in an ambiguous world where we are I don't know, heated all the time with the information. We have all this guru which knows everything. Why the stock has going down? Why the stock is going up? Because they find all this reason, like financial advertisement or something like,
Yeah.
okay, tomorrow Apple will be 400 euros, or tomorrow, I don't know, will be a huge earthquake, or so.
Yeah.
So
Sure.
these people, I don't know, tell you all this information, but if you make a statistical of the price of the equities, now you have something like a doctor. You have the patient list, so has this disease, this disease, this, so they can talk all the time. They are paid to tell you something, so all the time they have been paid to tell you, even if even we can tell you that, oh, in 2 years the price will go up, so buy today and wait 2 years, is the same things.
Yeah. So this ambitious thing is pretty interesting because nowadays everybody's talking about this VUCA world, right? Which is volatility, uncertainty, complexity, and ambiguity, whatever. Right? So like things have two meanings. One is the same thing as two or more meanings. Like you really don't know if what you interpret of a certain situation is really that right one or just one single angle of different views of the very same thing. And the same is true also in trading or investing. So if you make an analysis, of course, as a technical analyst, I know there are at least two scenarios. One is a favorite one, probabilities are higher, but of course, there are always a second one. Probabilities are not that high, they're lower, of course, because you just have 100%, but you never have 100% probability. You just have like, okay, chances are higher, probabilities are higher, like 60%, then it goes up, then probability are lower, then it goes down, they're just 40%. And if you do this over and over and over again, you will be profitable because you have much more, 60% of probabilities. This is the edge you have as a trader versus 40% of probability of not reaching the outcome. But of course, as we are investors and traders, we know both situations. We know, okay, probability was high and we made a profit. Okay, probability was low, but the market went anyway in that direction. So there's always this ambitious view to the situation.
Yes, and also in my experience, I have started with small percentages of winning, of profit, 1-3%, and go to next level, and I think this is a good approach, because you cannot start to invest tomorrow and say, okay, I will make 25%. So
Right.
so you must do it like the pro, step by step, and get rich slowly, and understand that the market has his point of view,
Yeah.
which the market point of view, it isn't equal, so it isn't like your opinion. So understand
Right.
that losses are a part of the game, and nobody will take you from your ear and say, okay, you have lose now, so tomorrow stop, do
Yeah.
not trade. It is a
Yeah.
part of the game, like the profit is a part of the game. We
Exactly.
are, I don't know, probably it is a good word, forced. We aren't forced, but all the time we think about the potential profit. So like a good girl, okay, let's catch it. But
Sure.
we aren't in a run.
No.
We cannot participate. We cannot participate today. We can
Yeah.
participate also tomorrow. Also, this
Right.
thing happens at the poker game. You know, when
Yeah. Sure.
you know that you have not a good hand, on your cards. You say, okay, I put the card down and say, okay, play without me. So also in trading, you can do this.
Yeah.
Nobody will get upset on you. So say, okay.
Yeah, exactly. Right. What's the last question?
This is the last question. I don't know. It was this one with the game level approach in your investment. So I started before. So I don't know what to say in the end. Now, so I will read it from this. A conclusion at the end will be that Arlt Wieland recommends that you should take a portion of your capital to trade it and know from the beginning of your entry the target of your profit and the accepted losses. It is all about the probability. So thank you all for this
Yes.
interview. So
Sure, you're welcome.
hope that you will make another interview in the future.
Sure.
Also, I can recommend also your book, Risk and Money Management. You will find it on Amazon.de. Search for Alt Wieland. So the presentation will be also on Facebook. So there are only 6 pages. So bye.
Great. Thank you. Bye bye. All the best.